And in this section, we're going to run a very quick level spotting, setup spotting type training here on the simulator. If we can get into some damage control, we can do that as well. If we take a couple of bad trades and try to illustrate the basics of damage control from a fundamental standpoint, and then go from there. Yep, just at a basic level for the most part, if we can. So level spotting is basically finding a way to accurately find areas in which price is likely to have a reaction big enough to be taken advantage of, right? So being able to spot resistance and support levels that have a higher probability of getting some sort of reaction. Again, the reactions at these levels are always going to depend on whether sentiment is driving something, or it's just a pricing in that is driving something, and with what force and what momentum that driving is happening. So one of the first things that you need to understand from the way that I level spot is that my levels are not price points. They're not exact price levels. So using level is probably a misnomer in this particular case, because what I'm doing is I'm looking for zones more than levels. So the levels that I actually draw, and the reason why I don't draw full zones is because that's just too many lines for me on the screen. What I'll do is my levels will usually be an aggregate, an average of the areas that I think where that support or resistance can be, with an average price to that zone. What I mean by that is that I'll look at, for example, in this monthly chart, I will look at these wicks. I will look at where the bodies are. I will look at where the highs are up here, where the closes and opens are down there. I will look at how that corresponds with anything here. And then when I go in and select my level, knowing that it's a zone, right, I will try to average everything out more or less to get the center point of that zone. Okay. So what I've done here is I've taken this into account. I've taken this into account. I've taken this. I've taken this, and this, and I've created a visual kind of at a glance average. It's not a mathematical calculation. I don't have time to go in and average out prices and go nuts. It's a visual kind of representation of where I think the middle point of the zone is, based on my experience and where my brain recognizes that turning points can be. The reason why this is useful compared to just going for a level and not acting until that exact price is hit is that the zone allows you to have a little bit of just widens your options in terms of when you can get in or out if you're using it as a target around that area. Yeah, it allows you to have a visual on a type of scaling in zone where you can start early, right, and finish up there. Or you can start there and finish up there on your scaling if you're shorting, and use that just as a visual reference. Yep. Obviously, on the higher time frames, there's going to be a lot more fluctuation above and below that exact price point, whereas on the lower time frames, you can probably be a bit more accurate, right, and come as close as being, just a few pips away, from the actual average. But on the higher time frames, it's going to be tougher. So basically, what this is we're looking at. Let's go into another time frame here as an example. Let's go down to the H4, because the idea here really is, and let me zoom out, to create an area of action, right? An area in which you are comfortable doing business that doesn't hold you down to a specific price point, right? Giving you the flexibility to front run or back run some positions, the ability of to be able to break down your bullets into multiple pieces is something that that you can do also thanks to having zones rather than absolute levels. And we'll illustrate that in a quick second here. But I don't want to spend too much time on this because we want to go into actual level spotting for this particular asset. But let's see. So I'm going to be looking here at creating some, let's change the color to black. All right. So basically this line here is what I think the average of this here. Let's get the color changed in this case. The gray, for example. Well, that didn't help. Hold on. There. And then this one here. So for me, the black line represents more or less this entire zone, yeah, where it catches some of the wicks from here as well. It catches some of the support from up here. It catches the wick up here. It catches the support down here. And this is a zone of action where I'm equally comfortable starting to short there and ending my scaling in for any short there, for example, if I were to short. Or I can just stick to the average point that I have, again, at a glance selected, and go ahead and just short there, right? If I don't want to front run anything. But I know that there's a chance that as price comes up here, right, it can react here, it can react there, or it can react there. Those are the three highest probability points, with the average usually being the one that edges the other two slightly in terms of probability for me. So basically, when you see my support and resistance lines, you need to visualize a zone around them, yeah, to fully understand why they're there. Because oftentimes newer members are going to come in, check out those lines and see, well, you know, that's weird. You're not exactly on any price point. There's no wicks that correspond. There are no bodies that correspond. You know, what's going on with your levels? And the reason is that they're not really levels, and they're zones, and they're just an area of, you know, preferred action pretty much in terms of what I want to do. And what you can do to get these zones as accurate as possible is to practice setting the zones, setting those ranges, those price ranges within which the reaction is most likely, based on a bunch of swings, right? It's always going to be the swing data that gives you these levels, you know, where prices turn and move and have reactions. So you're basically going to be spotting reactions that have happened previously, you know, to determine where the next possible reaction is around that zone. And you can, you know, use the system where you use a top band and a bottom band of the price range, and then put something along the center, and then delete, right? Remove these, you know, when you're done. So you don't, again, so you don't have 3 times the amount of clutter on your screen that you should normally have to keep things kind of neat. And then once those are gone, you know your zone, right? And you do it again for the next one. So as an example, we have an upper band here. We have a lower band, maybe, you know, here, more or less. And then I would probably average this zone out somewhere around there. And normally, you know, I would probably have a bit an offer to go short if I'm shorting, right? And if I need this zone for anything, around there, that would be my median point. What I will sometimes do is if I want to have 2, I'll have one here and one there. Depends again on the distribution of pips between levels to see if it matches my risk management plan for that specific asset. So if I can avoid to have a 80 pip separation between 2 bullets, and that makes sense, right? Because that's what I'm looking for in the plan. Then, you know, those 2 levels will be the levels instead of having one in the middle. let's assume that that's the case in this case because there's 80 pips. Then I'm doing the same thing. So for example, I would be putting this here, and I would be looking at, this level as the upper band, this level as the lower band, yeah? And I was putting an average there. Even at that level, I could go in deeper into the H1 or M15 of this zone and determine it, but I usually do it by eye at this point, which is one of the advantages of practice, yeah? That eventually you don't need to dig deep and find the levels exactly. And then if I wanted to put another bullet earlier, right, maybe I would put this here, more or less, and I would be using this as the upper band, the wick, and as a lower band, I would be using, the bottoms there, a little bit this level here. So at a glance, I would imagine that the average is going to be there, and that would determine my two levels or two zones for shorting, and they're individual to each other, which means that one bullet would be fired short there, and another bullet would be fired short there, yeah, more or less. But like with every zone, I know that I can front run them. If I see that price is coming up violently here and then stops short of my level and starts stalling, right? I'm not going to sit there and not take it because my level is here. I'll probably either take the full piece as a full front run, or I'll break down my bullet and take half a piece there and leave an offer with the other half available for the short, yeah, depending on what the circumstance is. But the idea of level spotting this way and creating levels out of zones is that you encompass more of the potential price action that can happen at that level, and you're not limiting yourself to a specific price point, because you're going to find yourself in many cases frustrated, especially if it's a very obvious point that the market is very clear on, that is being utilized for stop positioning or for order sitting. The brokers can see all these levels, right? And they're either going to widen the spread when you get there, or the market makers are not going to get to those levels, yeah, because they know that they don't want to trigger something specific at that point, whatever the case may be, or they want to trap you, whatever the reason is, right? The flexibility that you give yourself by thinking in terms of zones rather than price points is going to allow you to be a little bit more nimble and react quicker to these signs that you might not get the price you want. It also works conversely because we've been talking about front running, but the back running option, right, is also available. Let's say that price is coming in really hard into your level and you're not seeing any signs of it slowing, right? Some news, let's see that price was coming up here waiting for some news. The news hits and it kind of rallies because the news moves without current sentiment, and you're taking a mean reversion trade. If you think that the sentiment that you're taking that mean reversion trade is too strong, i.e. it has the potential for continuity past the current price, yeah, if you think that there's enough momentum to potentially break the resistance level that you're looking at trading, then you can always back run. And what that is you'll take the midpoint where you want it to get in and put in maybe half a bullet, and then wait until the upper band, right, of your zone, of your estimated zone, wait for a stall there, and then take that second half bullet as a back run position, which rarely ever happens for me, right? Because I usually take the potential stop hunts and overextensions of our level into account when creating the zone. But once in a while, if I think the move is too strong, I will certainly only put half at the initial area, and then just wait a bit to see if I get a stall shortly after within that bound or that upper band of the zone that I have used this as an average for, and sell the other half there. Does that make sense in terms of the zones and the levels for everybody?